Hey guys, so it occurred to me a few weeks ago that I'm coming up on my 20th anniversary of when I first started investing. And so over the past couple of weeks, I've been thinking really hard about what are the most valuable lessons that I've learned as an investor over the past 2 decades. So in today's episode, I want to take you through my top 20 investing lessons for 2020. So there have been a lot of books written about investing wisdom over the years, everything from Warren Buffett's value investing style to books on technical analysis and how to invest in startups. And so what I really wanted to do in today's episode is take a look at what I think are the top lessons that somebody could apply in 2020 that are relevant today. So lesson number 1 of my top 20 lessons for 2020 is you first need to learn to survive and then thrive. So the most important thing is don't do anything that's going to take you out of the game permanently, right? Like losses are a part of investing, but your goal first and foremost should be to not do anything that's going to take you out of the game completely, right? Don't take one trade or make one investment where you're betting all your chips on that one play. And lesson number 2 is to start by mastering one thing, right? One market, one setup, one niche, one specific strategy, right? It's really easy in investing and trading and even entrepreneurship to get distracted by all the opportunity that's out there, right? You have people beating different drums saying, trading this market is the best way to go, or invest over here. This has the highest growth potential, right? And it can be really distracting for newer investors or people that have even been in the game for a long time to go, where do I focus? So I think it's really wise for people to sit back and go, you know what? I'm going to focus on one thing at a time, right? Master one type of investing or master one market. Get to know something deeply and intimately instead of having like the dog and squirrel problem where you're like, you know, you're going on a walk and it's like squirrel over here or rabbit over here. And then next thing you know, you really haven't gotten anywhere, right? You're just chasing all this opportunity all over the place. And lesson number 3 is compounding is way greater than fast gains. You know, I think one of the most underappreciated lessons in investing is the idea of compounding over time. And we've looked at this, we've looked at the data on this in past We Talk Money episodes, just about the power of compounding. But no matter how much people talk about that, you know, how like the reason why Warren Buffett is so much more successful than everybody else is he focuses on compounding over time. And that's where true wealth generation comes in. But a lot of people are always looking for that next fast gain, right? Like, how do I take 5K and turn it into $1 million with like penny stock trading or something, right? What you really want to look at is what is the best way to sustain compounding gains over time. And then lesson number 4 is scared money loses always, right? If you are investing money that you need to pay your bills, right? To pay your rent, or you really need it for groceries, that's not risk capital, right? Like risk capital is money that you can take into a market and you can say, if I lose this, I'm gonna survive. I'm not gonna become homeless. I'm still gonna be able to eat, right? But if you're like, hey, look, I'm putting this money in this really high risk asset, like this altcoin or this, this low volume stock or something like that, or even a real estate deal that could go sour, right? If you're putting all your eggs in one basket and you can't afford to lose that money, what's going to happen is you're not going to make wise risk management decisions. You're going to come from a place of fear. And let me just give you like, right, that sounds good in theory, right? But like, how does that practically happen in the real world? Well, if you can't afford to lose the money you have on a trade, for example, you're going to cut off winners too early, or you're going to panic if it goes against you a little bit and sell maybe even at a small loss when really what it was a little bit of a pullback and then it was about to rip in your favor for 500% gains, right? Anytime you come from a place of fear, all wise decision making just goes out the window. So scared money loses always. Confident money is how you maintain consistent decision making, right? And you almost want to get to a point where investing is boring, right? Where it's routine, where you know yourself so well. You know your strengths, you know your weaknesses, you know where you should play, where you should stay away from. And that only comes from experience, right? If you're getting into the markets, you might say, well, Chris, I don't really know what I'm good at. And that's why I think it's good to like experiment with different things. But if you put too much capital in, again, capital you can't afford to lose, then you're going to get taken out of the game, which is ruining rule number 1. And then lesson number 5 is big gains come from anticipating, not reacting. In other words, it comes from thinking about what the mass majority of people or a segment of the population is going to do in the near future, not looking at what everybody is doing and reacting to that in retrospect, right? So for example, back in the early days of crypto in 2013, I said, despite Bitcoin being in a little bubble going from 100 to 1,000, I think that there is a much bigger amount of the population that's going to drive these prices higher later, right? And so by doing that, I was able to make big percentage gains and monetary gains from the run in 2015 through where we are today. And then lesson number 6 is correctly sizing your positions is everything. It's the biggest key, right? And what does that mean? What is position sizing? Well, position sizing is looking at your portfolio and saying like, what percentage should I put into each market, right? Like in my portfolio series, which I'm going to start doing more videos on showing the individual accounts and where I'm invested in, I think a lot, not so much about like each individual investment and whether it's going to win or lose, but I think as my portfolio as a whole. And then I look at, well, what is the right sizing? What are the levers that I should pull? Should I be heavier in this market or heavier over here? And that you can even get really granular and look at like the individual sizing of specific trades. So if you say, well, look, I just trade large cap stocks, or I only trade Bitcoin, or I chase penny stocks, whatever it is, you can pull the lever and say, based on this individual trade or this individual startup investment, I think the probabilities of an outcome are this, and therefore my sizing relative to my overall portfolio size should be this, right? Like Travis, the stock geek, which you've seen in a lot of my videos, he runs stock sizes anywhere of, from 1% of his portfolio up to 20% of his portfolio. And he uses the Kelly formula to help him decide how big of a position he should have in each stock, right? So he's a tactical stock long-term value investor, and he uses a specific objective formula called the Kelly criterion to help him decipher how he should size those. So no matter what your methodology is, no matter what strategy you're using, just really focus on position sizing, because at the end of the day, your win ratio, you could win 80 or 90% of the time and still lose money if your sizing is off, or you could win only 40% of the time. But if you manage risk to reward and position sizing correctly, you could be very, very profitable over time. And now lesson number 7 is don't chase the herd, but know when they're right. Okay, so this is kind of a catch-22, right? Because we talk about anticipating markets. We talk about, trying to be early, but not too early. But you can be on the same side of the masses and be right for a period of time, right? For example, this is fresh in a lot of people's minds. So the Bitcoin run from 2015 to 2017, we went from $166 to almost $20,000, right? The masses were right for a period of time, right? We had an early trend where Bitcoin's price went from a couple $100 to 500, then it pulled back. Then it went to 650 during the halving and pulled back. Then it challenged $1,000, and we had some China FUD news and it pulled back. And then it went to 3,000, right? Those of you that have been watching my videos or have been in our community during that time, you know what that was like. The herd was right? The mass majority of people were on the right side of that trade for a time. It wasn't until price went from 8,000 to nearly 20,000 in 3 weeks that things got out of control. But during that period of time, you could look at this, you could look at a trending market and say, wow, being long Bitcoin or owning Bitcoin seems to be the right play. Am I chasing the masses? Well, you don't have to chase the herd, but you can understand when everybody is on the right side of a trade for the time being, right? Everything is about timing. And number 8, this is my favorite thing to say, is trade less, profit more. I'll keep this one really simple. The less I trade and the longer I let my trades run, the better my results are. That's for me personally. You might experience something different, but after talking and working with thousands of people over the past 15 years or so, I've noticed this with the mass majority of people. Those that overtrade tend to underperform, and those that are very, very selective and let trades or investments develop over time, their net results are typically bigger. So number 9, look for asymmetric risk to reward. What does that mean? Well, you want to look at every investment opportunity. And again, I don't care if this is like real estate or buying a cash flow business, or if it's something like trading some financial market online. You want to be able to look at the picture as a whole and say, what is the risk and what is the reward, right? What's my downside and what's my potential upside? Because you never really know what the upside of an investment is going to be. But you can come up with a hypothesis, right? You could say, if my bull case plays out, if what I think is going to happen actually happens, this is where I think the price of this market could get to, or this is what I think this could look like. And then if you look at the worst case and you say, how much am I willing to risk through position sizing? And then like, where would I cut this investment off? Do I have an opportunity to manage my risk, to get out if it breaks a certain price? Or is this something where it's like a venture investment where you're like, I'm taking, a $25K or a $50,000 check or more, investing it in a startup, and my risk of loss is 100%, right? Whatever I put into it. So you want to look at, no matter how well you can define it, you just want to look for opportunities where the reward is many multiples of what the risk is. So for me, on like a financial trade, like a stock trade or a crypto trade, it's a bare minimum of a 2-to-1 reward to risk ratio, meaning for every dollar I risk, I want to potentially make 2 or more, right? That's a bare minimum. But what a lot of people do is they get caught up in emotion and they start chasing the markets, and then they end up with reverse risk to reward, where all of a sudden they're risking like $5 to maybe make 1, right? So just think about that. Lesson number 10, remove your ego. All right. Ego is the enemy. That's literally my buddy Ryan's book is called Ego is the Enemy. And the big thing when it comes to investing is if you attach your identity to the outcome of a trade or an investment, it's going to end very, very bad for you. That's what leads to revenge trading, right? Where you start chasing opportunity and it's just a downhill spiral to make up those lost opportunities. And then number 11 kind of goes hand in hand with this, is the opposite side, is when you're building size. So meaning as you start to trade bigger and bigger position sizes, get comfortable with the feeling of being uncomfortable, right? So what I mean is like, let's say you start with a small amount of money, you make some good investments and you double it, right? Say you go from $5,000 to $10,000, right? What's going to happen, or 100,000 to $1 million, doesn't matter. Just think in terms of percentages. But what happens is as your position sizes get bigger, you're going to constantly be kind of pushing that barrier of that comfort level, where risking $5,000 before was a big deal to you. All of a sudden, risking 50,000 on a trade or writing $50,000 checks to startups becomes a non-event, right? But as you grow size over time, which is really, I think, the goal for most people, then you're going to be constantly pushing that comfort level barrier, right? And so it's kind of like walking a tightrope between trading too big a size and trading with scared money, or not trading enough and then it becomes boring and you underperform because you don't care enough, right? You don't have enough chips on the table. So it's a fine line there. Number 12, top-down analysis can remove guessing. Now, what do I mean by this? So this is more like technical analysis focused. Instead of just sitting down and looking at a market or like turning on CNBC or some kind of financial news outlet and saying like, oh, what is the market doing today? Oh, it's up 0.5%. Oh, it's down 3%. Oh shit, I'm trying to make my decisions based on what's happening right now. It's like, look at things from the 30,000 foot macro view. Say, what is the general trend? What is the broad market? What's happening here on a multi-week, multi-month, or multi-year basis? And then drill down to what is happening short term, right? What's happening today? What are the key levels? What are the market structure, support and resistance levels? What's market sentiment? What's my fundamental analysis telling me, right? And if you work backwards like that from the biggest picture down to what's happening right now, it's just going to help you get in a flow where if you're just like jumping, again, like the squirrel mentality of like looking at every little thing and letting every news headline affect your emotional state and your decisions, that's going to lead to making too many decisions or even just bad decisions, right? So top-down analysis, I'm just a big fan of that. Number 13, don't let your short-term goals affect your decisions. So short-term goals in investing can be really dangerous, right? It's really the exact opposite of like entrepreneurship or building a business. If you're building a business, like say you have a sales organization, everything is driven by what are the results today? How many leads do we get? How many sales do we get? What's the lifetime value of a customer, right? Metrics, drive, push. With investing or trading, it's the exact opposite. If you force your short-term will on markets, it's going to lead you to do things like over trading or getting too aggressive with size, right? If you're like, I need to make $1,000 a day, and you start forcing opportunity to make that happen, not only are you not going to hit that goal, but you're going to start to go backwards. You're going to start to go in reverse. So instead of maintaining and compounding and growing over time, you're going to get in, again, that spiral of revenge trading or trying to force your will on the markets. And number 14 is, I think it's really smart to have non-market related income sources. If you're trying to pay your bills just by trading markets, now, if you have a really large capital base and you have decades of experience, maybe you can do that. But if you're like, I'm going to quit my job and just sit here and focus on the markets 24/7, the odds of you, again, playing with fear-based money or forcing your short-term goals on the market go way up. But if you have income off to the side where you're like, hey, look, my bills are taken care of here, and I don't have to make money today or tomorrow, and I get to sit back and be patient and wait for the best opportunity, that's really a great mindset to approach this stuff from. And then number 15 is health comes first. So if you are not taking care of yourself physically or mentally, then your decision-making process is going to break down. So I'm just a huge fan of getting out of the house, trying to do something physical every day. And this is going to be different for everybody, but just put health first, because if you put the markets ahead of yourself, eventually it's going to break down. It might not be today, it might not be next week, but eventually it's going to catch up with you. Number 16, losses happen. Don't let them define you. Okay. So again, kind of hand in hand with the ego is the enemy or drop your ego mentality is if you start to obsess over your losses, which can become very easy to do, right? If you're trading or investing and you make a good couple of plays and then you take a step backwards because you have a loss and you obsess over that, that's going to affect your future decision making. So each investment should be its own separate action, its own separate event. If you let the euphoria from past gains or the pain from past losses affect future decisions, that's not good. So think kind of like a poker player. Each hand is its own separate event. Number 17, and I'm going to keep this one short. I know this is going to piss some people off, but the data doesn't lie, guys. 99% or more of day traders in 2020 lose money, right? Not 80%, not 85%. Almost all day traders lose money. There have been many, many studies that have been done on this. It used to be different back in the day when the markets were less efficient and when the stock market was on the fraction system instead of the decimal system and pre-high frequency trading algorithms, right? I've been in that space for a long time. I've been in financial markets for a long time. I've seen how the core way that financial markets work has evolved over the past 2 decades. And I can just tell you, trade less, profit more. That's all I have to say about that. Number 18, this kind of goes hand in hand with day trading, is don't blindly follow gurus' trade alerts, right? It's one thing to get educated or to have mentors in the space. But if you are blindly trying to buy and sell based on when some guru sends out alerts, what's going to happen is A, you're not developing a skill. B, you're just chasing and you're likely to be late to the game. And even worse, if you're day trading illiquid markets, odds are that guru is front running you. So I'm going to do a separate video on what guru front running is. But essentially, if you are chasing somebody, they're probably trading against you, especially if you're day trading. So hold for longer periods of time, trade liquid markets, and learn what you're doing. Have a reason, have a plan for every trade or every investment that you make. Number 19, show up every single day. I can tell you this. So my investing style is 9 out of 10 days, I do nothing. Meaning I do not enter a new position or exit a position. 9 out of 10 days are wait and see days for me. That goes for every type of investing. And as you guys saw in my 12 asset video, I'm in financial markets, I'm in venture capital, I'm in real estate, I'm an entrepreneur and have equity ownership in many businesses. And so think about that. 9 out of 10 days are no action days. So it's few and far between that I'm actually doing something. But my idea is to show up every single day and be prepared. And that goes to number 20, which is flat is a position too. So you don't have to be long, you don't have to be short to be actively investing or trading. So what does that mean? Well, say you're getting into angel investing or startup investing. You don't have to cut a check to the first pitch that you see. Or if you're starting to trade financial markets, you don't have to make a trade on day one, right? Or if you're investing in real estate, you don't have to put an offer in on the first deal that comes along, right? Being flat is a position too. You're still in the game if you're showing up and you're thinking about portfolio and position sizing and you're waiting for the right opportunity to come along. So I hope this is helpful, guys. The question of the day is, which one of these lessons really resonated with you the most? Which one have you been struggling with that maybe this episode shined a little bit of light on? And also I want to mention that I created a quiz. It's called the Mental Strength Quiz for traders and investors, which will ask you just a handful of questions to kind of figure out, are you either a disciplined investor? Are you an emotional investor? Or are you a wreck and you need a lot of work? And then with that, I wrote this PDF called the Checklist to Becoming a Confident, Disciplined Trader and Investor. And I go deep on like 15 different ways to overcome emotions and really get on the right track. So if you haven't seen that already, I'm going to link that up in the description and the show notes. That just goes a little bit deeper. And obviously, if you have any questions or anything else that I can help you with, feel free to reach out on Twitter or on the We Talk Money website, where we answer questions every week in our group setting podcast. And again, I hope this was helpful. Thank you guys so much for watching or listening to this on the podcast. And I will see you next time. Take care.